Let's talk about the fuel that powers our world. It's a sector that for well over a century has been absolutely essential to modern life. And for investors, it holds the key to some potentially massive returns. I mean, think about it. From the giant container ships that cross our oceans to the server farms that power our digital lives, pretty much everything runs on energy. And right now, the vast majority of that energy still comes from oil and gas. So for any serious investor, understanding this sector isn't just an option. It's really about understanding the lifeblood of the global economy. It's the invisible force that moves everything from supertankers to your car on the morning commute. Okay, let's really dive into this. Welcome. The analysis we're digging into today comes from the work of Mr. Majid Butt, who brings this unique perspective as an accountant, a software programmer, and an investment researcher. We're going to break down this complex, really powerful industry into clear, actionable parts for you, the investor.
And hey, you'll definitely want to stick around for this one, because at the end of this explainer, we've got a really practical checklist for investors. We're going to go through 7 crucial points, word for word, to help guide your investment decisions in this sector. So here's our game plan. First, we're going to follow the journey of oil, from deep inside the earth all the way to your local gas station, by looking at the energy value chain. Then, we'll get into the 2 massive profit drivers that really shape this entire market. After that, we'll talk about how to find the companies that can win over the long haul, consider the key risks, and, of course, we'll get to that all-important investor checklist. All right, first up, the value chain. Look, to invest intelligently in any industry, you have to know the business. And the energy industry, it's really 3 distinct businesses all rolled into one. And it all starts here, upstream. This is the high-stakes world of exploration and production, or E&P as you'll hear it called. These are the companies that are literally exploring the globe, from the deepest oceans to the frozen tundra, searching for new reserves of oil and natural gas, and then figuring out how the heck to get it out of the ground. Now, this is where it gets really interesting for an investor. It all comes down to something called operating leverage. Just picture a seesaw. On one side, you've got a company's fixed costs. The drilling rigs, the employee salaries, the geological surveys, these costs are absolutely massive, and they don't change much whether oil is $50 a barrel or $100. So that side of the seesaw is weighed down, it's fixed. But on the other side, you've got revenue, which is tied directly to the price of oil. So when the price of oil creeps up even a little bit, that revenue side of the seesaw shoots up. And because the cost side is fixed, profits just go flying into the air. That's why a company's profit can multiply 5 times over, even if its revenue doesn't even double. It's a classic high-risk, high-reward playground. So once that oil is pumped out of the ground, it's got to get to a refinery to be processed, right? Well, that's the job of the midstream sector. You can think of it as the huge circulatory system of the energy world. It's not glamorous, but it's this absolutely essential network of pipelines, storage tanks, and terminals. And this is why midstream is basically the polar opposite of upstream. These companies operate like toll roads. You know, the toll booth operator doesn't care if you're driving a Ferrari or a Ford Pinto. They just collect a fee for every car that passes through. It's the same thing here. Pipeline companies get paid based on the volume of oil and gas they transport, not its price. This makes their cash flows incredibly stable and predictable. Plus, the rates are often regulated, and it's almost impossible to get permission to build a competing pipeline right next door. So you've got a business with a fantastic, durable competitive advantage. For investors looking for steady income and way less volatility, this is often the sweet spot. Okay, let's follow the chain to its final stage, downstream. This is where crude oil, which is pretty much useless on its own, gets transformed into the products that actually fuel our lives. You know, gasoline, diesel, jet fuel, even plastics. And then it gets sold to consumers like you and me. So the key thing to understand here is how refiners make money. Their profit is simply the difference between the price of the crude oil they buy and the price of the gasoline they sell. In the industry, they call this the crack spread. Now, unlike the upstream producers, who benefit from a powerful cartel we're about to discuss, there's no refining cartel. It's a super competitive business, which tends to keep those profit margins pretty thin. What's kind of interesting for investors, though, is that their cycle isn't always tied to crude prices. In fact, sometimes when crude oil prices crash, refiners can actually see their profit margins get wider, which makes them a potential hedge in a diversified energy portfolio. Okay, so we've walked the entire value chain. Now, let's zoom out and look at the 2 enormous forces that really dictate the fortunes of almost every company in this industry: the price of the commodity itself and the powerful cartel that helps control it. This chart right here really visualizes everything we just talked about. I mean, look at that first bar, exploration and production. As oil prices climb, profits just go vertical. That's that operating leverage we were talking about in action. Now look at the middle bar for pipelines. It's flat, stable, predictable. That's the toll road model. And finally, you see the refining bar is way less correlated, showing its own unique business dynamics. For an investor, this slide is like your strategic map. Where you decide to invest in this value chain directly determines how much exposure you have to the wild swings of oil prices. And now for that second major profit driver, a force so powerful it creates a structural advantage for the entire industry. OPEC. Put simply, it's a cartel. It's a group of the world's most important oil-producing nations, and their entire purpose is to prevent a free-for-all in production that would cause prices to absolutely crash. So here's the crucial takeaway for investors. OPEC's existence is a massive tailwind for oil producers. By managing supply, they effectively put a floor under the price of oil, keeping it well above what it costs most efficient companies to produce it. This isn't just economics either, it's geopolitics. Each member country has to balance its own budget needs against the collective goal of keeping prices stable. See, they don't want prices so high that it causes a massive switch to alternatives, but they need them high enough to fund their governments. It's a delicate tightrope walk, but historically it's been incredibly beneficial for industry-wide profits. All right, so we've got the lay of the land. We understand the industry structure, we know the key drivers. Now for the million-dollar question. How do we pick the winners? In a cyclical industry that's just full of landmines, how do you spot the high-quality companies that are actually built to last? Well, in a commodity business where the product, oil, is basically identical, it's really hard to build a competitive advantage, what Warren Buffett famously calls an economic moat. But in the energy sector, there are two really powerful ones. First is just sheer size. Economies of scale are everything. The giants of the industry can negotiate better prices on equipment, they can command better terms from service companies, and they have the global reach to optimize their operations. The second is what our source material calls the OPEC moat. The cartel's actions provide this protective barrier for the entire upstream industry, defending its profitability in a way you just don't see in other businesses. Okay, this slide is fantastic. It's like a 4-point inspection for any energy company you're looking at. First, don't just look at last year's profits. You gotta look at a full 5-year cycle, including the bad years. Did the company stay profitable even when oil prices cratered? Second, check the balance sheet. In a cyclical industry, debt is an absolute killer. A low debt-to-equity ratio is a sign of a smart management team that's prepared for the tough times. Third, the reserve replacement ratio. An oil company's reserves are its inventory on the shelf. If this ratio is less than 1, it means they're selling their inventory faster than they're restocking it. That's a business in liquidation. And finally, what do they do with their cash? Great companies in this mature industry generate tons of cash, and they should be returning a big chunk of it to owners through dividends and share buybacks. Smart investing is always about seeing both sides of the coin. We've looked at the opportunities and the signs of a quality company, but now we have to look soberly at the risks. What could possibly derail this whole investment thesis? Well, these are the 4 big ones. The single greatest risk is probably the breakdown of OPEC discipline. If that cartel falls apart and every country just starts pumping at maximum capacity, the price of oil would plummet and it would destroy industry profits. Then you have the rise of powerful non-OPEC producers like the US and Russia, which complicates the cartel's ability to manage the market. Then there's political risk. I mean, a lot of the world's biggest reserves are in politically unstable regions where the threat of having your assets seized or getting hit with huge taxes is always there. And finally, the big long-term existential risk, technology. The fast adoption of electric vehicles and the falling costs of renewable energy will, over time, eat away at the demand for fossil fuels. Now, these risks have been around for decades, but it's their intensity and the timeline that every long-term energy investor has to constantly be thinking about. All right, we've covered the entire landscape, from the wellhead to the gas pump, from profit drivers to risk factors. Now, let's bring it all home and put this knowledge into action with that investor checklist we promised at the beginning. Let's go through these carefully. Point 1 says, and I'm quoting, "The profitability of the energy sector is highly dependent on commodity prices. Commodity prices are cyclical. It's better to buy when prices are at a cyclical low than when they're high." Now, this sounds so simple, but it's the hardest thing to do emotionally, right? It means buying when the headlines are screaming about an oil glut and prices are in the toilet. This contrarian approach is where the real value is created. Then, point 2 builds on this. Even though the sector is largely cyclical, many energy companies keep their bottom lines black during the troughs. Look for this characteristic. This is your quality filter. Not all companies are the same.
You want the ones with low production costs and strong finances that can survive and even thrive at the bottom of the cycle. They're the ones that come out stronger and buy up their weaker rivals. Okay, next up, point 3. OPEC is a highly beneficial force in the energy sector because it keeps commodity prices above its costs. It is worth keeping tabs on the cartel's strength. As an investor in this space, you are basically a silent partner of the cartel. Their self-interest is aligned with yours. It's easy to get lost in the day-to-day news about OPEC meetings, but the big picture is that their existence provides that structural tailwind for the whole industry, so you have to monitor their cohesion. Then, point 4 draws a strategic conclusion from that. Because of OPEC, we view exploration and production as a much more attractive area than refining and marketing. And that's because OPEC's actions directly boost the price of crude oil, which is the product E&P companies sell. Refiners, on the other hand, can actually be hurt by higher crude prices. So if you believe in the long-term power of OPEC, your focus should probably be upstream. Moving on, point 5 states, working in a commodity market, economies of scale are just about the only way to achieve a competitive advantage. As such, bigger is generally better. Think about it. In a business where you can't compete on a cool brand or a secret recipe, you have to compete on cost, and scale is the most powerful way to lower your costs. The bigger companies get better rates on everything, they have more diversified assets, and they have the financial strength to invest right through the cycles. And then, point 6. Keep an eye on reserves and reserve growth, because these are the hard assets the company will mine for future revenue. This is so critical. A company's oil and gas reserves are its entire future. If that number isn't growing or at least staying stable, the company is slowly dying. It is the single most important asset on their balance sheet. And here we are, our final checklist point, number 7. Companies with strong balance sheets will weather cyclical lows better than those burdened with debt. Look for companies that don't need to take on additional debt to invest in new projects while also paying dividends or repurchasing shares. You know, a strong balance sheet is like a life raft in a stormy sea. And in this industry, the storms aren't a possibility. They're an absolute inevitability. Debt just amplifies everything, the gains and the losses. Companies with very little debt can survive a downturn and even play offense, buying assets from their bankrupt competitors for pennies on the dollar. They can keep funding new projects and rewarding shareholders from their own cash flow, which is the ultimate sign of a resilient, incredibly well-managed business. And that really leaves us with this final thought. We've seen that the energy sector is defined by these deep, often violent cycles. It's a volatility that scares a lot of investors away. But after breaking down the industry, the players, and the drivers, the question for you, the patient investor, is this. Is that volatility a risk that you should fear? Or, with the right framework and the right discipline, is it the very thing that creates the greatest opportunity?